So Steve, kindly share with us what the key highlights are and broader issues. We appreciate that there are very many. There's those that are very dynamic. Not every detail, but tell us, what are the big ones?
There are a number of big items in this finance bill. The first one is the proposal to bring back the Amnesty program. The Amnesty program gives an opportunity for automatic waiver of penalties and interest for those who come forth and pay the principal tax and apply through the Amnesty system. So this is big opportunity for all businesses with pending tax obligations, pending tax liabilities, or the ones who are actively now addressing tax disputes which are going to be resolved, or those who are under audits. So this is a big opportunity. Those who missed out the last window can now take advantage of this. The second issue that is major in this particular proposals is on withholding tax really. And withholding tax particularly on royalties. Royalties is payments to a number of use of several items, but more particularly on software. Payments for software, payment for license fees. The change which is being proposed here is that even if you just purchase software or you purchase licenses to use a particular technology item, you have to deduct withholding tax and remit to KRA at the appropriate rate. Previously, up to now, and this is something that has been litigated on by the sector, previously up to now, if you are just dealing in the software or you are buying or these licenses or these softwares and then you package them into a product which you then sell in the market to your customers, then withholding tax was not applicable. But the proposal now is that whether you are using it in your business or you are just trading in it, you're just in business, withholding tax applies. You can see every large business, especially in the financial sector, is going to be affected by this. Most of the suppliers of these digital goods are based offshore, and they do not take this impact on their earnings from the supply of these particular items. So this calls for grossing up. You pay them their money as per contract, you pay them their license fee or for the software or for the database as per contract, and it is then upon you to take your own cash to pay KRA. This means the cost that is borne of these items is going to escalate. Given that a significant amount of them are coming from countries with which Kenya does not have a double tax treaty, we are looking at a 20% cost escalation on this. This is massive. So this is another proposal that is coming, and I will propose that industry engages lobbying. The third one for the financial sector again is the card fees, the fees that are paid for the access to these card systems, and for interchange fees. All this, they are now being defined as royalties, subject to withholding tax. Similarly, the way I've addressed. This is something that KRA was deeming in an assessment, and it went to litigation, and they lost, but now they want to tie it into legislation so that then it's mandated. Again, this results into cost escalation, and it's likely to go the same way I've addressed that particular issue. Now, the other point is a proposed change in the deadlines for filing returns or attending to disputes. Right now, we have 6 months after the conclusion of the financial year to prepare your accounts, have your audited accounts done, and then you file your tax return. We have a window of 6 months. And this 6 months in itself is not sufficient. That's why people are always working late in audit firms burning the midnight oil in the last 3-4 months of every single financial year. That 6 months window is in itself not sufficient. But now we want to reduce it to 4 months. Remember, for large businesses, you have to conduct audit, which is a process in itself. The audits have to be cleared and signed off by the directors of businesses. Then you prepare your tax computations and file tax returns. So the 4 months window then really brings a lot of pressure to business. The other one is, as I have mentioned, the objections and appeals which are filed against tax assessments. The holidays and holidays are always excluded from this. The calculation of the days, the due date of the dates for the deadline for filing these applications challenging tax assessments. These ones are now to be disregarded. So in effect, about six days will be sliced off from the 30-day window for filing objections and appeals. And that, of course, is again bringing into the tight pressure in terms of deadlines. This is another proposal that is likely to affect many people. There's a proposal to increase the tax rate for residential rental income tax, which is earned by non-resident parties. It's now to be moved from 7.5 to 10%. So that is again another issue that is coming into place. There's a proposal to deem 5% of the value of second-hand clothes Mitumba to be income, and then KRA just taxes that straight away. So this, it may not be major for corporates, but it's going to affect a lot of Kenyans who enjoy wearing Mitumba clothes, and that is in itself a concern for wananchi. Now, there is the issue of the scope of CGT. The scope of CGT on disposal of shares of companies, especially disposals which take place outside the country. So offshore structures where a holding company in a jurisdiction, let's say Mauritius, is holding shares on a Kenyan business, and then those shares are disposed at that particular level. This KRA is seeking to invite the gain that is earned from that into Kenyan legislation. So far, this is not the case, except where that particular disposal generates the gain from immovable property. But now they want to bring this into scope. That will affect a lot of structuring dynamics, and it's something that we will see how it goes. I wish this would be assisted strongly in lobbying efforts, or especially by the private equity sector. There is the issue of definition of winnings for the gaming sector, gaming and betting sector, to bring into taxation the winnings made by people. This has been subject to a lot of litigation and lobbying over the years, but then again, it is back. Or taxing winnings by people who bet on these particular platforms, especially sports betting, is something that is disruptive to the business architecture itself. It does not sit well with the way these businesses are structured. When someone bets, they expect to get whatever they have won, and if they lost, they have lost. The tax obligation and tax requirement should rest with the house, should rest with the company itself, and not pushed on to the players. If this thing goes through, then it means it's going to encourage underground betting, which sees a situation where KRA now does not collect any money, and the local industry also loses. So this is likely to be a situation of a lose situation for the players, for these betting companies, and also for Kenya Revenue Authority. This is an ambitious experimentation, and I look forward to it being vigorously resisted in the lobbying effort. These are some of the changes besides the issue of VAT. Now, for VAT, a number of exempt items, a number of zero-rated items are now being reclassified as exempt. What is the implication of this? The implication of this is that whilst in the situation where the products of a business is zero-rated, that particular business can claim that the input tax which it incurs on purchases of goods and services relevant for running that business, so it can claim that input tax, input VAT, and if it is excess and the business largely is for supply of zero-rated items, they can claim the refund of that particular tax that they paid in input. In essence, to make that business tax neutral. Exemption is not a tax neutral structure because the input VAT that is incurred on purchases of items relevant for running that business, purchase of supplies, overheads, services for running that particular business, all the VAT that that particular business has paid. In the event the product is then reclassified as exempt, then all that cannot be claimed and cannot be refunded. It becomes part of the cost of running that business, and you can see it increases the cost. Now, the question is, will that cost be passed on to the customers? Is it realistic to pass on that cost to the customers? Many a times it's not realistic to ramp up your cost by passing on this to the customers. You have to absorb part of this cost for some time for price stability, and then later on you can pass on a bit more of it, then eventually probably all of it may be passed on to the customers. So this is disruptive in terms of cash flow. And if all this money is going to be locked permanently into cost, then businesses must now start looking at the issue of working capital or profit margins, returns from the business. And you can see how severely disruptive that can be. There are other administrative tightening mechanisms that are being proposed. For example, the proposal that refunds, VAT refunds that have been cleared to be refundable, that they not be automatically utilizable against import VAT. So you can see where this is going. I owe you, I can stay with your money as much as possible and only pay you when Treasury allocates me money to pay you. Yet I have already approved that these amounts are due to you. But when you are to owe me, you have to pay me right there at the port of entry, and you cannot utilize the amount that I owe you.
This is fair.
So these are some of the inconsistencies of approach that is being proposed, and these inconsistencies are only likely to add fuel to the fire of already existing of VAT refunds crisis, because then you cannot utilize. And it contradicts principles of taxation in a big way. Now, there are other clarificatory or measures that are being proposed, but they are largely administrative. But the key issues are the ones which I've addressed.
Great. I mean, that is so incredible. I mean, very well articulated, very well consolidated, and thank you so much, Steve, for those highlights. Maybe just to segue a little bit into Kelvin, tell us a little bit about the discussion surrounding software as well as digital payments. We appreciate that the definition of royalties looks to be expanded. Tell us a little bit more about that and what that affects those that are listening today.
Thank you, Koti. So just to add on to what Steve has said, the bill is quite conservative and is to be expected considering that it's going to be an election year. So the government is trying not to introduce very disruptive changes. So among the changes that have been brought is something that has been litigated over and over again. And this is with regards to especially financial institutions. And this is on definition of management and professional fees. So for the longest, the Revenue Authority KRA has been trying to tax the merchant and interchange fees that the banks pay and other financial institutions pay to their service providers. And this has gone up to Supreme Court, where it was decided as recent as December 2025, that since there is no clear definition of the management and professional fees to be included in the Income Tax Act, then they are not subject to withholding tax. And we are seeing the Revenue Authority trying to remedy that by bringing the definition of merchant and interchange fees on card payments to be under management fees, and also expansion of definition of royalty. Now it also includes payment services, settlement services, clearing services, and also switch services. So it's a target to the financial sector, and KRA is trying to just make sure that there is no point that they are going to lose in future. And also the definition of royalty has been expanded to also include distribution of software where regular payments are made to the distributor, again bringing the services of distribution of software under the ambit of royalty, which now technically means you have to analyze the withholding tax implications, especially if you're dealing with non-residents. There are different double tax agreements. You need to make sure that the rates that you're applying are the correct ones, and also where there is no double tax agreement, again, it becomes quite expensive for paying to non-residents.
I think, those are great insights. You've talked about the expansion of the definitions under Section 2 of the Income Tax Act. And maybe, Steve, I would want us now to weigh in on your great expertise when it comes now to dispute resolution. What is your opinion when it comes to some of these introductory elements within the finance bill? Do you think that the KRA is trying to reverse various wins that have been litigated in court through the various processes of tax dispute resolution? What are your thoughts?
So, from what the message that is coming home clearly from KRA in some of these proposals, where an interpretatory provision goes to court and the court tells KRA, your interpretation is wrong, it's very wrong, or please apply the correct interpretation. When this happens and they lose, especially when they lose consistently and in a big way in court, they come back and now change legislation to put the definition in the manner that they will have wished for collection of extra taxes. It means the message they are passing in regard to disputes, if the court says you are correct, if you beat me in court, I'm going to change the law to ensure that I beat you in the law. Yes. So this is the message that is coming, and it comes in that taste, and for the affected sectors, it will leave a bad taste in the mouth. But you can see the pressure on KRA to collect more money, to remit more money to the National Treasury, to meet very tight budgetary pressures. To work under these conditions, they have resorted to the desperate measures
that we are currently witnessing. Thank you so much, Steve, and for weighing in on your vast experience when it comes now to dispute resolution. Deeper, as a deal advisory expert, plugging into all the wealth of knowledge that you have, based off of the discussions that we have had from Kelvin as well as Steve, tell us, from a deal structuring perspective, why does this really matter?
I think it matters because when tax costs go up, they increase, then automatically it will affect the deal value. So when suddenly there's withholding tax implemented on software payments or on other payment, licensing fees, and those then get incorporated into the deal, and the deal value goes down. And the flip side is also that when buyers do their due diligence, they also will ask, have these exposures been taken care of? Have they been budgeted for properly? Have they been provided for? And if they're not, then this builds into the indemnities, it reduces deal value. So eventually all of this will affect EBITDA, it will affect cash flow and the deal pricing. And what this means is that for investors, it's not just about tax clauses, it's about the payment flows and how now these become deal issues rather than being back office issues.
Great, thank you all so much for your contributions and sound wisdom. Thank you.